Hello everyone, and welcome back to the Web3 Daily. The market's looking a bit sluggish today, isn't it? Bitcoin is chopping back and forth around the $110,000 mark. And that's got a lot of people whispering again, asking, is this the top? Is the correction finally here? But hold on, let's look at the data. While Bitcoin is consolidating up high with a slight drop of about 1.5% over 24 hours, and the Ethereum has followed suit, dipping below $4,300. Have you noticed that there isn't a real sense of panic in the market? From what I'm seeing, a lot of short-term players are getting a bit spooked and taking profits, which is normal. But on the other hand, the long-term holders and the big whale addresses, they haven't really budged. This kind of churn at the top is actually healthy. It shakes out the weak hands and reduces the selling pressure for the next leg up. So don't let this short-term sideways action scare you. The bull market playbook is often written during moments of hesitation and disagreement just like this. And frankly, when Bitcoin stabilizes, that's precisely the time we should be on the lookout for which strong altcoins are about to quietly start making their move. Alright, while the broader market might seem calm, in the world of altcoins, there's a big drama playing out every single day. And today's leading man is a familiar face, our boy, Justin Sun. Here's what went down. A project called World Liberty Financial, ticker WLFI, airdropped a massive bag of tokens to Justin. And what does he do? He immediately turns around and moves 50 million of those tokens, worth around $9 million at the time, straight to the HTX exchange. This move sent the project team into an absolute panic. They thought, he's about to dump on us. So, in a moment of desperation, they actually used the backdoor function in the smart contract called the Guardian Set Blacklist Status and straight up blacklisted his wallet address. The whole space just exploded after that. Can you believe it? A project team daring to blacklist Justin Sun's address. It feels surreal, right? Justin himself quickly responded on X, claiming he never intended to sell and that the transfer was just a routine test for HTX's wallet system. But the community's reaction was fascinating. Some said the project team overreacted and showed they weren't ready for the big leagues. Others argue that, whether he planned to sell or not, his action itself created panic, and blacklisting him was necessary to protect other investors. Of course, most people were just grabbing their popcorn, calling this the most entertaining crypto drama of 2025. The end result? WLFI's price completely cratered because of this black swan event. But this whole incident is actually a pretty sharp reminder for all of us, especially when we're deep in meme coin territory. The decentralization we talk about sometimes is not as absolute as you think. Your assets could potentially be frozen at any moment based on a single decision by the project team. So, before you ape into the next big thing, maybe take an extra second to look at the contract code. It could save you a world of trouble. Alright, now that we've had our fill of the Justin Sun drama, let's shift gears to some macro news that could have a more direct impact on our portfolios. The first story comes from the regulators in the US, and this could be a game-changing signal. The two regulatory titans, the SEC and the CFTC, just released a joint statement, and in a rare reversal of their usual stance, they've announced that they're clearing the path for registered US exchanges to list and trade spot crypto products. You heard that right? Spot products, not just futures. For years, the SEC and CFTC have basically been in a turf war over who gets to be the top cop for crypto, with SEC Chair Gary Gensler being notoriously hostile to the industry. Now, they're actually sitting down together to give a green light to spot products. The implications here are massive. What does this mean? It means assets like Bitcoin and Ethereum are one giant step closer to being treated just like stocks or gold, fully accepted compliant assets in the mainstream financial market. This is without a doubt a landmark moment on the road to regulatory clarity, and it signals that the runway for Wall Street's old money to enter the space is about to get a whole lot wider. Our second story today is the perfect follow-up to the last one. With regulators opening the door, you can bet the big institutional players aren't just sitting on their hands. We just hit a massive milestone. The total amount of Bitcoin held on the balance sheets of public companies, ETFs, and other institutions has officially surpassed 1.05 million coins. What does 1.05 million BTC even mean? Well, with a total supply of only 21 million, it means that nearly 5% of all the Bitcoin that will ever exist is now locked up by some of the smartest, most mainstream capital in the world. Leading the pack are the usual suspects, like Bitcoin's #1 superfan, MicroStrategy, the mining giant, Marathon Digital, and of course, Tesla. What does this tell us? It proves that Bitcoin is no longer just a plaything for retail traders and tech geeks. It's being treated as a serious macroeconomic asset, a form of digital gold on corporate balance sheets, used to hedge against inflation and preserve value. That consensus is rapidly spreading from inside the crypto bubble out into the mainstream business world. Of course, when you get this much attention, you also get more scrutiny. As Wall Street and public companies rush into the space, the regulators and exchanges are starting to step up their game. Our third story today comes from Nasdaq. The exchange has recently started to crack down on listed companies that are, let's say, straying from their core business. What does that mean? Well, a lot of companies have seen MicroStrategy's stock soar by buying Bitcoin, and they've started to copy the playbook. They raise money in the public markets by issuing new stock or debt, and then they turn around and use that cash to go all in on Bitcoin. Nasdaq sees this strategy as extremely high risk, as it fundamentally changes a company's business model and isn't necessarily fair to the original shareholders. So, they've issued new rules. Now, any listed company that wants to do this must first get approval from a shareholder vote and provide much more detailed and transparent risk disclosures to the market. So, what's the takeaway here? In the short term, this will definitely make it harder for companies trying to imitate MicroStrategy and might slightly slow the pace of corporate buying. But in the long run, this is absolutely a good thing. It shows that crypto assets have become so significant that Nasdaq has to create specific rules just to manage them. This is a clear move away from the Wild West era of crypto and toward a more structured, mature Wall Street model. And at the end of the day, rules and proper governance are what will allow this industry to grow sustainably. For our fourth story, let's talk about the builders. While the legacy financial institutions are busy setting rules, on the other side of the aisle, the top players from both Web 2 and Web 3 are busy paving new roads and building the bridges to bring the next billion users into the crypto world. The payments behemoth Stripe, the company that processes countless online transactions globally, has teamed up with the top-tier crypto VC firm Paradigm. Together, they've launched a new Layer 2 blockchain called Tempo, built specifically for payments. The problem they're aiming to solve is crystal clear. Gas fees on the Ethereum mainnet are too expensive and volatile for small, high-frequency everyday transactions. Tempo is designed to deliver high throughput with low and crucially stable transaction fees over the long term. The signal this sends is incredibly powerful. It's basically an announcement to the world that the next generation of global payment networks will likely be built on the blockchain. And the lineup of design partners they've assembled is an absolute all-star team, including names like Visa, OpenAI, and Deutsche Bank. This isn't some small-scale experiment. This is the A-team from both Web 2 and Web 3 joining forces to reshape the entire payments industry. True mass adoption never comes from hype. It comes from real tangible applications like this, taking root. Where there's construction, there is inevitably destruction. In the world of Web 3, light and darkness always go hand in hand. So for our fifth story, let's look at a critical piece of security news. I have to say, hackers' attack methods are getting scarily clever and stealthy. Recently, security firms discovered a brand new attack vector. Hackers are now embedding the download URLs for their malware directly into Ethereum smart contracts, hiding the payload on-chain. Then, they publish software packages disguised as normal developer tools, for instance, by uploading malicious code libraries to the NPM repository with names that look very similar to legitimate ones. If a developer accidentally downloads and uses one of these poisoned packages, it will secretly call that specific smart contract on-chain in the background, retrieve the malware's URL, and then download and execute it. The most terrifying part of this method is that data on the blockchain is immutable and can't be deleted. This essentially gives the hackers a decentralized malware server that can never be shut down. On top of that, traditional firewalls and antivirus software would never even think to scan the blockchain for malicious data. This is a massive wake-up call for everyone in the space, especially developers. If your machine gets compromised, everything your wallet's private keys, your project's source code could be stolen. The consequences are unimaginable when you're digging for gold in the world of Web 3. Security has to be priority number one, always. For our final story, let's talk about opportunity, because no matter how big the risks, nothing can stop the relentless enthusiasm for building and treasure hunting in the Web 3 world. The competition in the Layer 2 space is heating up to a boiling point. The current king, Arbitrum, recently announced a major move. They are preparing to splash out $40 million to launch a brand new DeFi incentive program, specifically designed to support and reward the projects within their ecosystem. Everyone knows how cutthroat the L2 race is right now. You've got base chain seeing explosive growth thanks to meme coins, and you have strong technical rivals like ZK Sync and Starknet breathing down their necks. As the current leader in total value locked, Arbitrum definitely feels the pressure. So this decision to throw cash at the ecosystem has a very clear goal: to solidify its throne and use real money to attract the best developers and the most user capital to stay within its walls. So what does this mean for us, the average user? It means that over the next few weeks and months, a lot of new money-making opportunities are likely to pop up on Arbitrum. For example, the yields on some liquidity mining pools might spike because of these incentives, or some projects might offer new airdrop potential to active users to qualify for the foundation's grants. It's definitely time to start paying closer attention to the Arbitrum ecosystem. Alright, that wraps up today's Web3 Daily Report. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical information in the Web3 world, the news that's closest to the money. We hope that by breaking down these curated stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for all the major exchanges in the comments section below. These are special high rebate deals we've secured for our community, and we hope they can help you save on some trading costs along the way. Let's all stay rational, move steadily, and build our wealth together in the world of Web3. May everyone's crypto portfolio grow steadily. We'll see you tomorrow.